let's look at the strategies then. To talk about a entry strategy, we need obviously a setup. So considering, and our assumption here is that we're going to consider we have a valid setup. Welcome, Nick. Welcome to all of you. Thanks a lot for watching this video, even if you're watching the recording. Now, a valid setup has to be identified based on concepts and systems that are grounded in the way market works, especially modern markets, a totally different animal compared to the markets that we only had 15 or 20 years ago. Okay, so when I speak about concepts, these are basically the main tenets on which your trading method is based, and system could be a number of things. Could be a trading system, could be a process that you use to analyze price, and so on. Now, you have to use things that actually work, that actually represent something fundamental about the market. Otherwise, your setup might not be valid. Now, of course, I use some of the research I've created in the years, the FibStalker methods levels, and much more recently, the last 2 years, dump and smart money. So studies of how dump money is actually affecting price. And we'll talk a little bit about that in this brief presentation here. Now, a system has to have and produce setups that have an edge, and a system, and any system will produce a trading plan for you. Now, what is a trading plan? It's a collection of information. It's a collection of bits of information. The first one is, of course, which market you're trading, or if you're trading a financial instrument which is derived from a market, which financial instrument it is. For example, you could trade euro-dollar, but you could trade also the futures on the euro-dollar, which is basically the same thing. A direction can be long or short. An entry price or an activation price, and that's something that a lot of people do not understand or consider in their trading. When a price gets to an entry price, especially if you are trading retraces, you may want to wait. You may want to use that as a way to warn you that something is actually happening or about to happen. And I will not talk about this now, but basically an entry price can be used to enter a trade or can be used to activate a trade. And I'll explain a little bit more what I mean with that. A confirmation price, which might be the same or different from my match. The entry price may be different from the entry price, and we'll see example of that as well. A stop price, of course, because we don't know the future. We accept the fact that the market can bring to us anything. And position size, which is really the WAGR. I mean, how much you are sizing your position. Some people use fixed lots. That doesn't make any sense. And in another video, I'll show you why that's the case. And of course, we need targets. Every time we enter a trade, we need to know where we're going to take profits. For example, today in the morning, we took profits in the trading signal service room. We actually took profit on an euro-dollar short. So we need to know where those profit targets are. However, there is also another type of target that I use. It's called the risk-free target. And this is a practice that I teach and love to teach to starting traders as well as beginner and traders who do not have a lot of experience. It's a very, very important technique. This is a trading plan. Don't make a mistake. Don't mistake the trading plan for the trading system. The trading system is what produces the trading plan. So the output and outcome of a trading system applied to current price gives you a trading plan, and this is a trading plan. A trading plan is a very simple set of information which is actionable. which market, which direction, what's the entry price or confirmation price? Where is the level where the stock market is telling me that I'm wrong? What's the position where I'm going to get out, and that's it. That's a trading plan, actionable set of information. So now let's give an honest look. Some people use or pretend or think that fire and forget can exist or work in the markets. And I've spoken about this last week as well. We talked about that, and I invite you to review that presentation as well. You find it on FX Street. Now, it all depends. And in that presentation, I showed scenarios where fire and forget could be considered, and scenarios in which clearly the market is telling us that you have to watch the market in order to capture and understand what's going on. And the key is always to limit risk. In fact, risk management is trader's job number one. Now, if you have a little bit of experience with the markets, you know that you can and have to expect anything from the market. In fact, there is a rule number one of trading: anything can happen in the markets. And this rule has been nicely laid out by Douglas in his book on training in the zone. So this is very, very important. It took several years to me to incorporate this rule in my trading. Now, if we accept this principle, rule number one of the market, and if you don't accept it in the long term, sorry to say that you won't be successful, then how does this affect our trading? And now we factor this rule in our trading. So, well, enter two pieces of information that you have always to keep in mind when you time or enter a trade. First of all, confirmation level. I work with confirmation level at all times. I want to see price moving in my direction before I get involved, even if I have to sacrifice gains, or I have to get a slightly lower reward to risk. There are also situations in which using a confirmation level allows us to adjust the stop, which actually brings that reward risk back to our wanted levels. This could be 3, 5. In some cases, if we time on a very small time frame, like 15 minutes, it could be 10. And the second important concept is to learn to work with risk-free trades. Especially if you are a starting trader, use of risk-free trades it's very important because it helps you staying the course. I often receive questions of traders who are either in the room or I work with who say, I'm having a gain in the market. Should I move my stop to the entry level? And the answer is always no. You have to leave the market. You have to leave, at least in my style of trading, I leave the market all the room it needs to move. And risk-free trades, it's one of the devices I use for risk management, as well as to make sure that I stay the course, and most importantly, that the new traders stay the course as well of a trade. Now, if anything can happen in the market, what does it mean for our setups? Okay. Well, it means that price can actually blast through our entry price and never look back. So if I have an entry level that I identify with some method, for example, a FibStalker level, and I have a stop level as well, which I've identified with same or other methods, like for example, smart or dump money. Now, if anything can happen in the market, it means that, sorry, just deleted that. So I'll trace it again. This was our stop level. This was our start of entry area. Now, if anything can happen in the markets, the market could come into this area. Instead of reacting in this area, it could just continue and stop us out. Of course, this is the worst scenario we could get. We were ready to trade here in this area, and we blindly buy this level and the market just moves, keeps moving, away from our entry. We accumulate loss until we lose our 1 unit of risk here. So this is certainly not a wanted scenario. But that's exactly what it means that anything can happen in the market. Whenever we have a setup, we don't give that setup for granted ever. We don't give price for granted ever. And here I had actually the levels here. And of course, the wanted behavior is that the market somehow reacts into this area, never stops us out, considering that in this simple example, I'm going to put a stop below this level, but this is only a simple example. That's what we want from the market. We cannot ask anything to the market because the market can't do anything, and anything can happen in the market. Or I should say everything can happen in the market. So how do we avoid this? How do we avoid that price blasts through our entry? We need to have some sort of device that tells us when there is participation from players in that setup area. And in the previous image here, this is my setup area. Okay, my setup area is between these two blue lines, which is the start of the entry, and the red line, which is my stop. So this is my entry area here, okay? So again, how do we do that? We need these devices that help us to understand whether at these levels here, there is participation. We want participation to start coming within our area of the setup. And so that's where confirmation levels come handy. We use them so that, and only when the area where a reversal, we anticipate a reversal, is tested, is touched. And look at the use of words. Words are powerful, okay? And I wrote this and left it here on purpose, okay? So we should actually remove all our expectation we have on the market. We can only have positive anticipation, but we should not expect really anything from the market. And if you start using this terminology here, you program yourself to expect something from the market, and that's not really something that you should be doing. We do not expect anything from the market. What we do, we actually anticipate a market behavior. And I left that word on purpose. So be very careful and picky when it comes to trading about the words that you use, because you are basically pre-programming yourself. And we use a confirmation level that becomes active, as we say, as I said before, when the entry price is touched or tested, and when the players start pushing price in the direction of the trade. Okay, that's exactly what we want. So we don't want to enter right at that blue level I showed you before, or entry level here, but we want to make sure that before we enter, we start seeing some participation from, in this case, smart money or Algos or whatever is the concept that you use in order to identify an area where price should bounce, okay? And so I want to start seeing that participation, and the confirmation level is for me a way to say that that participation is actually entering the market. So now when the confirmation level is reached, that's when I enter, and this greatly reduces the risk of the trade and increases also the reward to risk sometimes. So in a way, we lose on the reward to risk in order to wait for confirmation, but then we get some back as we can adjust our stop as well. Now, I talked about players. Who are these players? Well, there are many different types of players, but I actually, in my simplification of the market, and don't forget that everything we do is a simplification of what happens in the market. In fact, I love when Van Tarp says, we don't trade the markets, we trade our beliefs about the market. And my belief is that there are at least two groups that I want to monitor behavior, and I want to monitor also how these two groups affect price. The smart money and the dump money. Now, who is the smart money? Well, this is the group of traders and market participants who know what they're doing. They are large banks, professional traders, program trading, so specific classes of algorithms, and generally algorithms that can have different objectives, time frame, and activity on the market. One of these classes is high frequency trading, which is now really a market that I consider smart money. It will not affect price and directional trades on the daily and weekly, but it can affect the market in a very, very small time frame. In fact, in that course that I proposed to you before, it's a free course, I also show an example of how high frequency trading can actually modify temporarily our setups. And I think that it's very, very fascinating. The other group is the dump money. These are the traditional tech analysis crowd, the trend following crowd, the discretionary trader, the people who believe that they can consistently trade the market only based on discretion. And what happens is that these people usually have, if any or ever, they might have success at the beginning, and then they start getting into a streak of losses, and they recognize that they cannot choose a discretionary approach with the markets. And there are also the don't have a clue but being a trader is cool type of group or traders. And obviously, we know where that leads to. Now, smart or dump money don't win or lose at all times. But keep that in mind, the smart money initiates and leads market moves. So, however, and whatever you use to model markets, you will see that they tend to start trades. They tend to start a reverse market. They tend to lead the moves by keeping pushing the price higher or lower, and keeping to push price into targets, whether using participation and positioning on large or smaller time frames. All right. So on the other hand, we have the dumb money. And the dumb money has a totally different effect. Dumb money tends to obstacle price and follows market moves. So it doesn't lead, but follows. And so often it's either wrong or late, because we know very well that following always produce lags. A typical example are moving averages, right? So if we follow moving averages, we always lag price, and more often than not, we will be wrong. And that's the reason why simple trading, trend following systems with very simple rules, only make sense on very large time frames, and they give back a lot. All right, so if these are the two groups, remember always, and this is my belief, that in order to win in the trading game, we have to stalk the smart money. And now this gives you a little bit of an idea of why, my nickname is FibStalker. Particularly, then I use Fibonacci study in a non-conventional way, which is actually very effective. And it's not something I have created. I have actually taken part of my method from my mentors, and I believe it works pretty well. So most of my research is around stalking smart money, which means to identify where smart money gets into the market and stalking it. All right, so it's pretty interesting concept. Now, the other device I showed you before, so I talked about confirmation levels and who are the players and why it's important to stalk smart money. The other concept is risk-free trades. Very often I hear, I talk about risk-free trades, and then I hear, participants or attendees say, okay, but I really don't get it. What do you mean with risk-free trades? So let me explain this concept. It's very, very simple concept. Now, risk-free does not mean that you can eliminate risk. In fact, risk in trading cannot be eliminated. Okay. However, we can do something. And before I tell you what, always remember that trading is a business, and every business has risks. If you treat trading as a job that gives you a steady income, you're not getting it, and you'll be forcing trades that do not belong to your portfolio of trades. And that happens all the time. Why? Because maybe people come back from holidays and say, I have not traded for 15 days or 1 month. I need to get back to it, and I need to produce some gains. Well, that's a job mindset that you bring to trading, but trading is a business and it has risk. So risk in trading cannot be eliminated. Now look at this interesting statistic here. 90 to 95% of new businesses disappear after 3 to 5 years. Have you ever asked yourself why? And this is common concurrent statistics. In fact, it is also said that the 80% of the remaining 5% disappears after 10 years. Okay, so the big companies that we see that last for years and decades, they are probably 2% of all new businesses that are born every year or less. Now, does this number sound familiar to you? Well, I spoke about this, and we know very well that 95%, actually between 92 to 95% of traders, they actually lose money in the market. And I have proven this formally as well in a presentation on FS Street. So if you're interested, you can find that among the free material, or write me an email and I'll send you the link. So if that's the case, is that surely because a lot of people are not considering it a business, but as a business has its own risks. And so any devices that we have that help us manage risk are always very welcome. So risk can be removed if price moves in the direction of the trade for a certain amount. And I'm going to show and I'm going to explain you what I mean with that. I just want to make you notice that if we indeed can do this, if we indeed can remove risk when price moves in our direction, obviously what we want to take opportunities in area that we know that have a high probability of moving price away from the entry and in the direction of the trade. So can you see how the method or system that we use in order to identify setups also is linked to ways we can remove risk. So if we have multiple methods, then shouldn't we not pick the methods that help us remove the risk as soon as possible? The answer is an obvious yes. And that's the reason why, for example, breakouts from consolidation are considered to be a lower risk. Now, I'm not convinced about this fact because I think this is true in a specific situation, particularly investing in stocks Of course, a lot of people use it successfully in Forex and all the other instruments as well. But I want always you to think that whenever price is breaking out from a consolidation level, it is also very, very close to a target level. And that's the reason why very often we look at breakouts. They work initially, and then price simply stops at targets and comes back. And as we don't know whether the trend is going to continue or not, there is a risk that the market will come back and actually stay below our entry price. So I particularly do not consider breakouts as setup generation opportunity, but we can use breakouts successfully for entry, so for our timing. All right, so okay, so I will continue here. I think we're still live. Yes. All right. So I think this discussion is very, very important. Risk can be removed if price moves in the direction of the trade. So let me try to explain here. And this is what we our entry area that we showed before. Now, let's suppose that this new orange level here is our confirmation level. If the market comes in this area and never breaks above the level, well, we could be stopped out. However, if we are able to identify a confirmation level that when price moves above it, then it actually is actually suggesting that there is participation from the players in this area, then this becomes a very, very important device. Now, if we use this approach, there is another level in our market, in our chart, that I call risk-free level. Now, let's suppose that we enter 100% of our position here above the confirmation level, okay? And the risk-free level is a new level above entry for longs and below entry for shorts, where we that when price gets, and if price gets into the level after the trade has been triggered at this confirmation level, when price gets at this level, we have a gain, which is represented by the number of pips or ticks between between the risk-free level, the green risk-free level here, and the confirmation level, which is the orange level, which equals basically the initial risk that we got on this trade. Okay, so the gain we have here equals the risk that we have at the beginning of the trade. Now, this is the risk-free level, and the reason why it is important is that if we remove 50% of our position at this level, then our trade becomes risk-free. And what that means is that if this market actually does something like this, then confirms and then continues higher into this level, and we remove 50% of our position, at this point we can go away with our lives without not even worrying about this market any longer, because this market can do anything. Of course, it can come back to entry and we will still be in the trade. And of course, it can also come back to stop us out. And that would be a loss of 50% of our initial position. So by using this device, by using the risk-free level and removing half of the position at this level, when the market comes back, if we lose half of our position, well, we are at break-even. We can close this trade at break-even plus cost of trading, Okay, so very, very simple concept, but very, very powerful concept, especially for all of you who have problem in staying in a trade. Of course, there are a lot of critics about this approach because people say, well, you are taking 100% of your risk at the beginning of your trade, and then when your trade is going in the direction, you just remove half of the position. And I say, yes, this is much more valuable as a tool to learn the correct beliefs to trade the market than the actual gains you're going to do. Because if you can do this consistently, then you can increase your gains using money management. All right. So this is my answer to the critics and people who say, you know, you take a lot of risk here, then you remove half of the position. And I say, yes, I do that because I have money management that helps me increasing profits, and I'm establishing a sound foundation for trading. So this is very, very important, okay? Now let's come at the strategies. At the beginning of this presentation, I promised 3 different strategies. The first strategy is to enter at the entry price level without waiting for confirmation. Now, probably you understand that this is not the best approach here. And then what I say is that good luck, you're now at the mercy of Mr. Market. But don't get me wrong, we always are. In fact, at the very moment we enter the market, we lose control. And the only way to manage is to manage before, to do the good homework before entering the market. And we have some tools that help us to do that. First of all, and most important is accepting risk. If you're starting with trading, go with 1% and learn to trade. Actually, if you're starting, you should really paper trade and do other testing activities as well. But if you're starting, if you believe you reached a reasonable level, then don't risk more than 1% of your account, and there's no need to make initially your account big. Work on a small account. In fact, in the same presentation where I showed that 95% of starting traders lose money in the market, I also showed that they lose between $2,000 to $6,000 in a period of 3 to 6 months. Okay, that's average. So don't be above average. Try to be below average. Actually, try to take yourself out from the average behavior and follow sound suggestions. Make sure that the setup is the result of a grounded way the market works. Wait for confirmation that players are pushing the market in your direction. That's basically what I have mentioned before. So now these strategies, I give you the foundation. So these strategies are very simple to explain. And use priorities management and execution. For example, hard stops with no exception. Don't be discretionary. Don't be a trader who wants to trade systematically and then falls into the pitfalls of discretionary trading, like having soft stops or mental stops, doing exception because you believe that this time the market is stronger. It's not such a thing. And the point here is that I really believe that strategy 1 is not really a very good strategy to work with. Okay, now let's look at strategy 2, which involves confirmation level, and you start understanding that this might be something you want to look at all times. We enter at the entry price level only after confirmation, and actually what happens is that confirmation changes the entry price. So the confirmation typically become our new entry price. So in this case, when you look at entry price plus confirmation, remember that we use entry price in this specific case to activate the setup. So when the entry price is the first time tested, our setup becomes active, and once the confirmation level has been identified, the confirmation level typically becomes our new entry price. So as you can see, the entry price in this strategy 2, it's used to activate the setup, and the confirmation price is used as our new entry price. Okay, so this is the way we use confirmation. And most importantly, as I mentioned before, confirmation is our device that helps us understanding that that the market is now moving in our direction, in the direction of our setup. Okay, and that's very, very important. The best approach is then to wait that the price approaches the entry level. And again, as I mentioned before, it activates the trade this way. And then we obviously we realize that to do that, we need some sort of filters, we need some sort of devices that help us tell when players are participating at that level. So these filters are no other than timing techniques. And I personally use two different techniques. I use the proprietary FibStalker timing technique that looks at the end of participation of smart money in the counter trend move. What that means? What that means is that we have the start of an area of participation, and we have, let's say, a stop. And this is my area where I anticipate that algos on this time frame will actually come in and participate and reverse price. But in modern markets, we also know that price and algos exist on price on all time frame. So my first technique attempts to identify the sequences that the algos in the counter trend, which is this trend here, it's a counter trend into the setup, and we expect, or anticipate, I should say, not expect, the price to reverse. So the FibStalker timing technique studies the counter trend move into the level and studies how algorithms are affecting that move. And in strategy 2, I use confirmation using the FibStalker timing as a way to tell me that algorithms are not any longer willing to push this price lower in the counter trend move. This is very powerful, I believe. This gives us an indication that now the algos that are coming from the larger time frame can reverse this price, because smart money is no longer interested in pushing this price lower on the counter trend move. Okay, so this is the first timing technique. So again, it looks at the end of participation of smart money in the counter trend move. The other one is the study of behavior of dump money that obstacles price and particularly price moves initiated by smart money. And dump money often forgets the price can turn on a dime. So dump money does not realize that in some cases that things have changed, and now the market has reversed. I think a great example, if we just look very briefly here at charts, is represented by the US dollar Japanese yen. I just want to give you this example. I remember vividly at the beginning of the year, it was February, when I got a very clear indication that the sequence of measure move higher in this market had ended. And that confirmation came exactly this week, the week of the 22nd, ending the 22nd of January, when smart money clearly showed that they were not interested in pushing this price higher. I vividly remember that there were people in the community who were looking for US dollar Japanese yen to 130. or 31. And I mentioned very clearly, no, guys, we're not getting there. And I put my money, my mouth on it. And we actually have called these trades shorts also on FX Street in the Tokyo Open Room. And I mentioned this is going to be levels where we're going to see smart money and dump money actually pushing this price lower. And that's exactly what happened. So there were people who were looking at this 2 weeks rally as the start of a move that would bring this price at 131, while I was saying, no, we're going to go lower. And so can you see here that in this specific case, there were a lot of people who were actually represented by this dump, a monthly dump money long, who were still looking for longs, but Algos and smart money was looking for shorts. Okay, so this is very example, and it happened, by the way, it happened again, and much more clearly here recently when we saw the 170 level being tested here. And let me show this to you again, because this is very important. When the market actually touched the 170, which we knew well in advance, in fact, I knew this level since this high was actually printed. I traced the level. And so we knew this level in basically end of May here, and it came into play, sorry, end of May last year, and it came into play in July, June this year. Okay. Now look at the beauty of it, which proves what I'm saying here. After this level has been tested and the smart money came into this market, dump money on this weekly short dump money area actually pushed this price lower. But they couldn't do more than that, because we knew, and smart money showed us again their upper end, that this area was being participated. Eventually, dump money tried to short this area again, but eventually smart money, which initiated, number one, initiated the move. Number two, led the move. Okay, initiation, leading. So this is a representation of what I'm trying to say here. So studying the behavior of dump money, that obstacles prices just showed you of moves that are initiated by smart money. And remember always then this, smart money initiates and leads, while dump money obstacles and follows. So who do you want to follow, right? So as I mentioned before, I want to stalk what smart money is doing, because smart money leads, and we can see this on charts as well. Now, let me close this part with a strategy tree, because then I want to get into reviewing the four markets. The strategy tree is for specific conditions in the market, and we enter at current levels, which is not always advisable, on market moving quickly, and the targets are well away. And an example may be represented by the euro dollar at the beginning of the week, or the New Zealand dollar now. So we'll talk about this when I'm going to review those markets. This is not the best strategy, so you should be very, very careful, and this is only for more experienced people in reality, but can lead to gains and will not make you miss extended moves. Avoid it if you can. Again, as I mentioned, risk management is just job number one. If you don't have experience, just stay away from this strategy. I use it from now, every now and then. Not ideal, and not building the right beliefs about trading, because you will start believing that now you can jump on any move that has started already. While you should always remember that, as one of my mentors said, if you see a move and you're not in it, then the move has ended. Go away. Don't get involved if you don't know what you're doing. But if you know what you're doing, you can participate with a small position and ride the move. Here the key is small. Why small? Because if you keep your risk fixed, and you already have a setup with an entry and a stop. Let's say that you want to trade this market on the upside. And this market does this and never touches your entry point and activates the trade. And then at some point you say, you know what, I'm going to enter here. Yes, but you still have all this risk. If you enter it here, you had this risk here, 1 unit of risk. Now, this larger PIP risk or tick risk has to be equal to 1 unit of risk anyway, which means that your reward to risk goes down, okay? And so this is one of the problems of this approach, and you have to know what you're doing. Reward to risk of these trades are typically much lower and not so good. And so it's not so easy to reach your objectives in trading using these approaches. However, again, if you know what you're doing, and most importantly, you need to stomach retraces because, as I showed you before, the market can actually do that. Let me show it to you. You have to be able to stomach retraces. Why? Because that's exactly what can happen. You have your setup here, your area where you anticipate participation from algorithms from larger time frames. The market never gets there. And what it does, it gets away from you, and now you decide to enter here. Okay? And then the market does this. Comes to trade into your level and could even stop you, right? Of course, you can trade into that level, and this is the outcome. This could be the outcome, the most probable outcome. Otherwise, we would not enter at these levels. And as you can see, you have to stomach all this move lower here, from here, this point here, to this point here. Are you ready for that? Are you built for that? And do you understand that? And are you ready for that? Okay, so this is very, very important. So it is important that you are ready to do that. You will not benefit from confirmation when you do that. Confirmation might never come. Confirmation can only come when the entry price is tested. And however, there are other advanced techniques like price discovery that I teach in my FibStalker coaching program and down money analysis that can help. All right, so